let's quickly delve into Truworths. The company reported a 14% increase in first half profit, lifted by higher prices and new stores. South Africa's biggest listed clothes retailer and said diluted headline earnings per share totaled 272.3 cents in the 6 months to December, and that's compared with 238 cents a year earlier. The group's retail sales increased by 10.7% to 4.8 billion rand. Truworths has announced expansion plans with 13 new stores to open in South Africa and 6 in the rest of the continent. Paolo, let's start off with you.
Yes.
Gaining market share. It's sitting at on the clothing front at 22.6%, 2010 figure 22.2%, so slightly up above that. And then menswear also growing to around 22% from 21%.
Yeah.
So slowly gaining traction on that front.
Having traded reasonably well, but I think looking forward, it's not without its difficulties. I think some of the competitors will come through quite strongly, the likes of Foschini and so forth. And a lot of this market share gain may well have been achieved through the identity brand name, and that traded certainly quite well. If you look into the earnings, though, maybe one has a little bit of concern that they might not have been that strong. They might even have one might suggest struggled a bit. They got margin improvement, but because of their sales were not as low as previously, so they got some margin growth through that. But the margins are at their maximum, and so one questions how sustainable.
Operating margin sitting at almost 37% from around 36%.
That's right, and that was done partly because when they do the inventory sales, they were able to hold better prices than previously. The question is how much more can these margins grow, of course. So they're pretty much at a peak in our view. But nonetheless, it's still a quality counter with really strong management, but it's becoming a little bit more difficult, of course.
Liston, are you of the same view? Do you think that margins now are perhaps going to stabilize at these levels?
Well, I'm almost guaranteeing they come down. There's no way, if I build a model going forward for this company, that I'm able to put in 37% sustainable. What number I'm going to put in 3 or 4 years' time, that's a different matter, but that really is unsustainable. One side, they're talking about cost increases coming through, but the thing that favored them, and we'll hear the same from Massmart when we talk about it, is the deflation. Now, deflation is a wonderful thing if you're a consumer, but at the same point, we're hearing about a deflation in terms of some of the input costs, but we're finding that they've got a margin of 37%. It doesn't call for too much imagination to find that somebody else on the same street or in the same mall is able to say, how are they doing this? What are they doing? Much of the discussion we had a moment back, and saying, well, I can do that too. So I'm honestly saying that margin is unsustainable. And when you hear about 13 new stores, it's on such a large base that doesn't really help. Certainly when one looks at retailers, that's what it's all about. It's square meterage and rand per square meter.
Listen, when you look at the product inflation the company's talking of, they're saying that product inflation averaged around 8%. It's completely different to what we see. Even Massmart, we know, has been experiencing deflation, and the other retailers as well. But here we are, we're sitting with an inflationary environment on the product front for Truworths, and they say that it could remain between the 6 and 8% level going forward.
Yeah, that's what I'm saying. The story is, it also depends exactly which lines and where. But the point I'm making is that no matter where you look at the inflation side and you look at your margin, it's unsustainable. How I would do the exact costing of bringing it back is very difficult to say. But that's the note of caution that I put into the analysis of this company.
It's probably just worth noting there as well, when you talk of the inflation growth of 8%, you look at comparable store growth of 6%.
6.2%,
It kind of implies that they're struggling on the volume front. And that's why I mentioned earlier, you may well find that competition is also starting to give them a fair run here. So volume's under pressure, of course. And the other thing going forward that's probably worth considering is that the real wage growth in the public sector is also most likely to slow down, as was mentioned in the budget. So all the
public sector wage bill will most likely slow. We're hoping that other wages will actually increase.
So their real growth, of course, in wages is going to start to narrow, which implies that all of these type of retailers may well struggle going forward with this type of growth in margin and so forth.
But Paolo, the truth is we've heard this before when it comes to Truworths and Foschini and the other, clothing retailers, that we're worried that how much higher can the margins go and where else can the growth really come from, and they keep surprising to the outside. Is this going to now be the make or break?
Well, look, they have surprised on the upside. I think that's a fair comment, of course. But if you do go back, you do see there's been real wage growth, and I think that has filtered into these type of counters. Having said that, if we are to believe what is being said going forward, then some of that will certainly slow down this kind of growth. The other action that these companies will take, which they certainly have taken, is to start to open up the credit a little bit and allow that gate to open, which they have. And if you've seen the growth of credit, specifically in the identity store, it's actually significant, very large.
Hot or not for you, Paolo?
Not hot at the moment, just overpriced in our view.
Run.
Yeah.
Liston, hot or not? Truworths?
Not, no.
Just a not, no commentary, no detail.
Well,
colour.
I'm not sure how much time we're going to how many time constraints we're going to run into.
You've got a few seconds.
I think if we look at it, if we look at it, two sides to it that I think are important. The one is that the rand really weakened only in the last quarter of last year. So you're coming into this year with a much higher cost base, no matter what you want to say or do, no matter what kind of inflation was underlying in the year gone by. And I think that is certainly something that you would have to take into account, if you were working this one forward. The second one is, without a doubt, all retailers have benefited from the fact that there has been real wage growth within the economy. And that has provided extra purchasing power for an awful lot of folk. And that's been allied with no increases in interest rates, so housing bonds not taking an additional out of the discretionary spend. And I think they've ridden that wave, and they've ridden it particularly well. I'm just not sure that I want to put that multiple going forward as an add-on, from here. So really, that's why I'm cautious. I'm just saying I think it's been the purple patch, it's been the wonderful wave, and I'm not sure that it'll land you on the beach, but I just don't think that you want to ride it too long.